Hey everyone, it is Evan here from the Trade Risk on Friday, November 16th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So we did close red right across the board, across all the major averages on the week. We did finish off of the lows of the week, which was at least mildly constructive there, or giving a little bit of credit to the bulls, which we'll talk about in just a moment. And this is the final full week of trading before the Thanksgiving Day holiday. We have markets closed Thursday of next week and a half day on Friday, so we have a short holiday week coming up on Monday. So let's jump into the markets here with the S&P 500 cash market. This is the weekly time frame, and like we said, we closed red on the week, down 1.4% in the S&P 500. Notice though the tail on this week's candle, we did get a nice lift off of the lows of this week. We were down over 3% on the week at the lows, 3.5%, but we did get a nice rally back from that 2670 area to close right around 2742, back above last week's lows, and kind of holding up at the upper end here of this last 2-week rally. So structurally, the market really hasn't changed a whole lot here. On the weekly time frame, we are still below the long-term trend line here that extends from the 2016 lows. We are still in this chop here of recent 5 or 6 weeks worth of trading, and we are very much still in the middle ground of this larger year-to-date lows to highs sideways range. So structurally, not a whole lot has changed. We still should expect a little bit of chop, but we should respect at least some of the tails now that are stacking up here on the weekly time frame. So 2 weeks ago we had this nice rally off of the lows. We have another one coming up here. So maybe the buyers are starting to kind of step in a bit here and test the waters. Now let's go down to the daily chart and switch over this view here, my other board. We can see that we did get that bounce back towards the end of this week. So that's what created the tail on that weekly session, on that weekly bar. We did get this nice reversal here on Thursday, and then we added to those gains on Friday. Now, in the midweek video, we talked about this 2700 level. We talked about this open gap here in the S&P 500 back from the 31st of October. We talked about the fact that we were down 4 days in a row, stretching 5 days in a row potentially to come in and fill this. And this would be a good line in the sand for the bulls to step in and reverse this market. And so far, they are in the early stages of at least demonstrating that. We did get a bit of an overshoot here, but we filled the gap. We held this nice round psychological 2700 level, which has played a role in the past of earlier in this year. And we did get this bounce here into the end of the week. If we go to the SPY ETF here, as many people like to keep an eye on this ETF, you can see same thing. We came down and tested about 267 or so. We filled the gap over here, and now we're starting to lift back higher. We did get long. We are long the S&P 500 right now. So on this reversal here, this was enough of a reason to get involved for a tactical trade. Certainly not looking to be a hero here or be stubborn. If the market decides to roll over next week, we will very quickly be out of this trade, but for now we're going to see if this support here in this stabilization that we saw Thursday with a little follow through on Friday can stick for a move back up into or towards this 280 level. So we do have a tactical, what we consider a tactical long position on in the S&P 500 right now. So that is this 270 level, or really, now I think this is a good line in the sand to use is really just last Thursday's reversal low. So this 267 basically on the dot now, that's going to be a good line in the sand. That is where the bulls now stepped in. That's where selling sort of exhausted itself on this recent leg down. That's where we saw the reversal step in. It's only 2 days, so it's not a meaningful heavy reversal at this point. Certainly that should be noted as we're just starting to break this downtrend line, but I think that is still a good line line in the sand here where if we want to give the bulls credit, let's give them credit above Thursday's lows. If we start to roll over here, then I would very quickly be looking at the lows made back on the 29th of October, coming down into this 260 level if we start to take out Thursday's lows. On the upside, again, 281 or so, that's about where we topped out, double top, if you will, over the past couple of weeks, couple of months. So I'm playing this range here, 260 to 282, with this inflection in here right around 270. More acutely would be down towards that 267 level. And again, our tactical trade playing for a move back up towards the upper end of this range. So that is the S&P 500 still offering up some volatility in both directions here. It's easy to get chopped, so again, don't have to play every day. Pick your spots, and you know, we'll see where this market takes us. We are heading into a holiday shortened week. Generally speaking, Thanksgiving week has a bullish bias to it, a bullish seasonal tilt to it. It doesn't have to be the case, but you know, we tend to see that over the years, so we'll see if that holds true into next week, as volume is expected to be lighter next week, as most people are taking the early time off to get to eating their turkey, basically. So that is the S&P 500. Those are the levels we're looking at. If we go to the IWM here, very similar kind of situation. We have this recent pullback for 5-6 days in a row. We got the reversal on Thursday, and then we got a little bit of a follow-through day here on Friday. It is still kind of wedged in between this larger range here on the daily chart from 158 down to 144. We're pretty much in the midpoint of it. We're trying to reverse now to the upside. Bulls would love to see the lows from Thursday stick here as well in the IWM. Notice both in the S&P 500 and in the IWM, we do have a bit of some bullish divergence going on here in MACD. It's not, you know, a true retest here, but we are inching higher. The MACD is trying to still cling on to this zero territory up here. So despite 5 days pulling back, giving back 50% of this range, the MACD didn't give back 50% of its low to high on the recent rally from the 29th all the way up to the 7th of November. It gave back about 10% of it. So a nice gradual slower decline here. That is the ideal situation on the pullback. You don't want to see it slamming back down, heavy volume, very quick. And we do have that little bit of divergence there on the SPY, the IWM, pretty much across all of the major averages, and frankly, even individual stocks at this point are starting to show a little bit of positive divergence there. So Qs, finally, our last major average we'll analyze here. You can see it did stabilize, reverse a bit on Thursday. We didn't quite get that follow-through day on Friday. We did have some weakness out of earnings, NVIDIA, some different things going on influencing it, some weakness still in some of those large cap weighted companies, or mega cap companies, I should say, things like Facebook, Netflix, and so on, still weighing on the Qs here, but structurally it's not a whole lot different. It did fill the gap. It's holding above these recent lows here. There's still a little bit of MACD positive divergence going on there, and we'd really like to see the lows back from Thursday hold. Otherwise, we'll be back to retesting that 160 as sort of a next level to pay attention to. So that is really the market overall. We had some stabilization. I mean, even though the markets did close lower this week across the board, we saw the VIX come down almost 8%. Well, that was on Friday. It was still up 6% on the week, but still a pretty good fade overall. It is down below 20 once again, so trading with an 18 handle there. So a little bit of constructive action in the short term, but it's a thin leash right now. It's thin ice, maybe, so to speak, and we'll want to see the lows here from Thursday hold in the short term to prevent further, you know, sort of carnage or retests of the October lows. So let's get now into some other major markets there. We'll go to TLT, which is clinging and kind of continuing to trend higher here, grind higher, back up towards the highs here from October. right around this 115 level. We talked about this range. We talked about the fact that this did in fact hold right here when things looked like they were at their worst, when TLT was looking its ugliest right here. It didn't get that follow through. It had some inside sessions. It resolved it higher and paved the way to a nice rebound into the upper end of this zone. So constructive action there in the short term. Longer term, still in a very tough spot here for TLT. 117 broadly speaking, that's the big level we would want to see reclaimed for the more intermediate to long-term time frame. For now, it's good to play the bounce here. If you're in it, certainly, you know, you can trail your stop, take some profits, do your thing, but just, you know, be aware that structurally it's still in a vulnerable spot there for the longer-term trend in TLT. Next up, we go to oil. Oil, which here was the big story of the week, and some massive volume coming in here. Biggest volume week we've seen in the USO ETF anyway since 2016, and this is coming off its 6th week in a row to the downside. It ended up dropping from high to low about 28%, and that was again in about 6 weeks worth of trading. So a pretty massive decline there in very short order for USO. We did see the huge volume. We saw a little bit of a move off of the lows here this week, but not a tremendous amount just yet. But given how oversold and how stretched and how much sort of capitulation was likely run here on this day, it wouldn't be surprising to see some type of recovery, relief, dead cat bounce, if you will. And frankly, it's moved so much lower that you know, it could move all the way up to $13 and still and still just be very much a dead cat bounce. So it could easily bounce 12% here from the lows to up to this $13 area, and that would still be, you know, a trend that is dominated by the sellers. So USO clearly favoring the active trader now, the shorter term. I mean, we didn't have huge ranges here on Wednesday, Thursday, a little bit more on Friday, but if we start to lose 1180 or so, then, you know, maybe the game's back on to the downside. But it looks like we've at least capitulated in the short term. It's trying to stabilize here with these inside sessions, so looking for that recovery bounce here. If you're tactical, if you're nimble, makes sense, but you know, longer term structurally still in a very, very tough spot. Natural gas here, again, as we said, it's almost been, you know, oil's loss has been natural gas's gain, and we saw just some huge moves this week, really in both USO and UNG, but UNG, incredible 19% move here on Wednesday after an already extended run, and then we gave back 19% the following Thursday, and now we're up 11% here on Friday. So quite a roller coaster, lots of volume pouring into this, but there does seem to be that panic momentum, chase, squeeze, whatever you want to call it. There's incredible volume lifting here to the upside in natural gas. We remarkably still have a position here, just 25% left. We've sold most of it. We're trailing a stop, and this thing had run so much, nearly got stopped out here on Thursday's session, but we were saved, and our stop continues to now trail fairly aggressively underneath price. So we're sticking with this for now, and we're going to look to see if the bulls here can continue to make this run to the upside here. Quite historic in nature. It's really tough to chase here, and looking at levels, you know, I really would prefer just looking at the spot futures contract to get more accurate measures. Clearly we have this supply in here from 2016, 2017 around this $38 level, but if you looked at the contract, you're looking at, you know, $5 pricing. That is probably, you know, using your technical analysis on that, I don't think TC2000 can get a clear rolling sort of futures contract here for UNG. If there is, let me know. I don't know what the symbol is for TC2000, but UNG is what we're limited to, and for now we'll just look at the shorter term trend, and it continues to remain higher above moving averages. If we start to break down here, then you know, certainly we would be out, and that might signal that the party is over, at least in the short term. So great move there in natural gas, ended up being 17% on the week, well off of the highs, but you know, still some very impressive gains. Finally, if we go to metals, they did start to, or they did turn around this week. They did start off weak, but they did find their footing, kind of like the equity market. They were up 1% here in GLD, back above 115. That's constructive to see. That was a line in the sand that we've been continuing to use here, and it is nice to see gold back above 115, maybe a higher low of sorts with this recent decent kind of shakeout here on Tuesday and Wednesday. So short-term bulls trying to reclaim action, trying to get that momentum back into positive territory. But you know, at least you have a little structure to trade against now as bulls start to get that upper hand again. And silver also again holding on and reclaiming these lows after briefly making new year-to-date closing lows on Tuesday. There was no follow-through there. We did see a higher volume reversal on Wednesday and then further push higher back into this range. So for silver, all carnage has been contained so far, $13 and call it 12 cents, 10 cents. That is now the level to pay attention to, kind of a double, retest of this, and it held. So we would look to see if we can just meander back up into this range. $14 to $13 approximately is the range here in silver. So plan accordingly. And I think that's it. So let's jump now into some of the sectors now that led this market higher. XLB materials, this is one of the first to break down here. This is one of the worst looking in late September, early October, when the market started to see its little correction there. That was one of the first to lead us to the downside. It got really oversold here. It stabilized, and now it's actually looking pretty good here from a sector component basis. It really didn't give much back. You know, compare this to say the S&P 500 or the IWM, the Qs, whatever you want to look at, the broader market. Most of those major averages retraced 50 to 60% of the rally here over the past couple of weeks. And look at XLB, it pretty much held strong here in the top 20-25%, and now it's already starting to lift back really close to the highs made back on the 7th. So there is clearly, you know, still technical damage here on this weekly time frame. It's still in a sort of suspect mode, but it does look like maybe we capitulated enough over here that this is resetting quicker on the upside. So technically, I like the way this is set up. Maybe a second leg higher next week. We'll see. But XLB was your top performer this week. It did close positive by almost 0.5%. Utilities was our second best performer here. Did close slightly positive, back up, kind of working against this $55 highs. Again, I always sort of suggest if you are interested in the space, the individual REITs definitely offer either some better technical pictures, generally speaking, and there are some interesting names breaking out on a longer term basis. It is the REITs, you know, they are REITs, they are slower, slightly more boring names. I know traders sort of avoid that space, which is fine if that's your prerogative, but I would pay attention to some of the individual components rather than the XLU there. And finally, XLI, so this is Industrials ETF here, was the third best performer on a relative basis this week. It was still down 0.6%, but similar, you know, kind of comments here. This was one that got really beaten up. It did find support right into these 2017 structure in here, and it did get this nice lift off. Notice on this pullback as well, it didn't really retrace 50-60% of the prior rally higher. It did hold on to the top third or so, and it's trying to stabilize. You can see the MACD is still continuing to chug along higher here, still in negative territory, but trying its hardest to get back into positive. So I like this little cluster of 4-day highs here over the past 4 sessions, and if it can start to pop over 72.40, ideally on volume, ideally with some urgency, then that sets up for a nice move, you know, at least retesting this recent high and then maybe a second leg to the upside. On the downside, worst performing was discretionary ETF. You can thank Amazon a lot for that, as it was weak this week, going back to fill its gap from just a couple of weeks ago. But XLY looks very similar to what you see here in Amazon. It's retraced again most of it. It did fill its gap, but it is suffering a bit here. It's, you know, again, 5-6 days down in a row now. If we count over the past, really just didn't stabilize at all this week. I mean, it put in this nice, this nice hammer here on Thursday, inside session. So there's potential here that this inside day can springboard higher here. If we start getting above 107 next week, there is some potential here, as 107 seemed to be a spot that the market struggled with right in here on this cluster of 3 days back on the 23rd, 24th, and 25th. can see right in there that cluster of highs ended up popping back. It's back below it. So if we can start to get back above 107, this inside day resolves higher above this Thursday's hammer, then maybe you have some move that could give some lift off there. But for now, in a pretty tough spot. IBB, you know, this 101, this 100 to 101 level just continues to hold here. It's been tested many times since 2017. It continues to hold. It got tested again this week, and it did get a little bit of a bounce. It's still in the 2.5% to the downside this week. It was still in one of the worst performing sectors on a relative basis. You still do have, you know, if you look at this MACD, you do have positive divergence though. When you look at this retest of the October lows to where it is right now, you can see we are getting sort of a positive drift there for the MACD. Finally, XLK, you know, really, again, not looking on a relative basis the prettiest here. You still got a MACD that's trying to rise. You still got a reversal attempt at hand. You still have the lows here from the Monday the 29th trying to stabilize there. You're at the bottom end of a range, so it is an important area to hold at these recent lows around 66, 65 and change, but you know, something like an XLB just looks better poised, or even like an XLI looks better poised up here with dip buyers you know, firming this up quicker than going all the way back down to the lows here. So be a little cautious, but either way, you know, if this market can hold recent lows, is essentially one of the narratives right across the board, then you know, we could see a nice little Thanksgiving Day rally for next week. So that is the market recap for this week. Hopefully you guys enjoyed it. Thanks so much as always for tuning in and watching. You can subscribe on our YouTube channel every Tuesday and Friday for the market recap videos. Thanks so much, and I will talk to you guys next week.